Okay, let's go to chapter 14, since we have to finish it. And next week, I have to finish chapter 15 and 16. So it will be also a busy week. So let's go to chapter 14 and start. So in chapter 14, we learned already that stock is can be common stock, can be preferred stock. It's a transferable units of ownership in a corporation. I can buy a stock of, let's say, Amazon today and sell it tomorrow. Just easy as that, specifically if it's a publicly traded companies. And when a company like, let's say, Facebook wants to go public, let's say, I don't know, 10 years ago, they issue initial public offering. They offered for the first time for public to buy their stock. And at that time, I believe it was initial IPO of $38 for Facebook. And it went down all the way around 27 on the very first day. At that time, I was thinking if I had money, I would definitely invest for $27 on Facebook because I knew it's going to go up. And Facebook right now is how much? After a few years. If you go to Yahoo Finance and you put, I think Facebook changed name. Facebook, Meta. Yeah, they changed the name, and now it's 169. So imagine if you invest at that time, it would be very interesting. So this is the max that I can see. Yeah, you see here, $26 right there, $26. Oh, it went all the way to 18. Unbelievable. That was 10 years ago. And so it went all the way to 18. But when it went all the way to about here, $26, like there, at that point, I was thinking, oh my God, if I have money right now, I will invest on this IPO today. I didn't have, but if I would, let's say $100,000, let's say $1 million. Let's say if I invest $1 million here, now my investment would be like what? For almost 7 times more, right? 7, 8 times more. So it would be like, oh, here was it very expensive. Oh my goodness, $379. That would be 12 times more at that time. $12 million. Make sense? So that's what IPO is anyway. And prospectus is the documentation describing financials and business aspect of the IPO. Here is a disadvantage for corporation. You know, there's a double taxation for a corporation. The reason is double taxation because the corporation will file taxes, pay taxes for the income, and then they pay dividend to the shareholder, and then shareholder all of a sudden needs to pay taxes again. So that's why it's like a double taxation scenario. Okay, so we have either common stock in most cases, but sometimes we have also preferred stock. So common stock is, as it says, the residual equity interest in a corporation last in liquidation, but usually receiving the full benefits of any corporate growth. That means if you have common stock, if the company goes bankrupt, you are the last investor in line to get paid for it, if something left after liquidation. Creditors are the first, preferred stock is the second, and then common stock is the third in line. Preferred stock, normally it's a little bit more expensive, but it's a class of stock that generally benefits from a stipulated periodic dividend. That means they have priority to get dividend first, preferred stock. And if something left, after paying the preferred stock dividend, then common stock will get the rest of the dividend. So the dividend priority goes to preferred stock. And also in time of liquidation, after creditors, preferred stock is the second in line to get paid. Okay, and common stock, normally it will increase in the price in future. So if the stock price goes up, then they will get the benefit. Investors will get the benefit of that price appreciation. But preferred stock, normally they don't have that benefit. Common stock is also has the voting right compared to preferred stock. Preferred stock cannot vote, but common stock normally they vote, but not the preferred stock. Primitive right is a proportion to buy a portion of the shares that has been issued, extra issued later on. That primitive right is intended to let the shareholders to avoid ownership dilution by being assured an opportunity to purchase a fair part of any corporate stock expansion in future. In the liquidation, again, the preferred stock gets paid first and then common stock second after satisfying all creditors. Okay, so those are good reading stuff. Cumulative. A preferred stock can be cumulative or non-cumulative. It's a if it's a stock is cumulative, that means if they don't get dividend this year, preferred stock will get the dividend next year as soon as it's declared. So if they don't get paid dividend this year because no dividend has been declared, then the dividends becomes in arrears. Dividend in arrears, that means the company didn't pay dividend to the preferred stock last year. Some preferred stock might be also callable. There's a call price for that preferred stock, and if the company chooses to call, then they will call it. And let's say if it's 105, then that means they pay 105% of the original par value. Convertible bonds, that means the convertible stock, that means a stock that can be converted to common stock. So preferred stock can be converted to common stock if they like to do that as a shareholder. Not every bond, every stock, preferred stock is convertible, but some of them might be. If it's fixed maturity date, it says that means there's a specific date already that the company has the intention to buy the preferred stock back from the investors. What is par? Par is just a word, a technical word, nothing else. It's a so-called legal capital. That means if you have par value, then you cannot issue the common stock for, you can issue for whatever you want, but you cannot record it more than par value in the common stock T account. Let's say a par value can be a cent, can be $1, can be whatever. So in this example, let's say you issue a common stock, 100,000 shares with a $1 par value. If this is a $1 par value, that means 100,000 shares times $1. You cannot put more than $100,000 in the common stock. Yes, you collect $1 million for this equity financing, but $100,000 goes in the common stock. So the remaining 900,000 goes in another T account. We call it paid in capital in excess of par dash common stock. Paid in capital in excess of par dash common stock. And that's where you identify the additional capital collection for issuing stock. Any question, please? So far, so good? Okay. And when they declare dividend, so obviously they debit dividend, but because it's just declared, they record that as a liability. We call it dividend payable. So there are 3 dates in the dividend. One of them is the date of declaration, which you need to do journal entry here, just like that. And then there is usually 2-3 days. In that 2-3 days, anyone has the stock will be get the dividend. So if you like to, it happens to me several times that I bought the dividend somewhere in this green area, like it's about a month, right? But imagine I bought a stock right here, like a day or 2 before the green ends. And because I bought the stock right over there by chance, then immediately like a week later or 3-4 days later, I got a notification that I will pay, because I had a stock of that corporation, I get, let's say, $3 dividend. There you go. That's the date of payment. So date of declaration, you need to journalize it. Date of record is a date that they record who is the owner, who needs to get paid for this dividend, and then they make sure everyone that is in this owner needs to be paid. But then there's no journal entry on this, but there's a journal entry on the date of payment. So ex-dividend is the event or date when a transfer of stock ownership between shareholders will occur without the right for the purchaser to receive any previously declared dividend. That means ex-dividend date. That means after dividend. The presence of preferred stock. Let's see. Okay, let's look at the picture so it explains much better. So this is the equity section. We have capital stock as a headline, okay? But for capital stock, we have 2 types of stock. We have preferred stock and we have common stock. So yes, capital stock will be in 2 pieces, either preferred stock or common stock. Let's go to preferred stock. Preferred stock has a par value, whatever it might be. Let's say $100. And also preferred stock has a cumulative percentage, 8% cumulative or 8% non-cumulative. If it is 8% cumulative, that means if they don't get paid this year for because of not declaring any dividend, then next year they will get paid for both years. If it says non-cumulative, that means if they don't declare this year anything, then sorry, next year you just get for the next year. Year 1, forget it, gone, no dividend. 8% means 8% of par. So how much dividend this preferred stock will get? 8%, which is in the agreement, of par. 8% of $100, which is $8. 500,000 shares authorized. That doesn't mean it is issued. It just means it is authorized to be issued. However, how much is issued? 200,000 shares are issued and outstanding. That means issued and still outside with shareholders. So 200 shares issued and outstanding. 200,000 times $100 par value, that's $20 million. Got it? 200,000 times $100 par value, that's 20 million. Let's go to common stock. It's a $1 par value, 2 million shares authorized. That's it, just authorized. However, 400,000 shares are issued and outstanding. So 400,000 times $1 par value, that's all you can put it there. That's 400,000. So 2 million plus 400, it's $2,400,000 capital stock. However, we have additional paid-in capital too. Additional paid-in capital dash preferred stock and additional paid-in capital dash common stock. So additional paid-in capital, that's extra money that they collect for the preferred stock and extra money they collect for the common stock. And that's 36 million here, plus 20 million, that's 56 million total paid in capital. Okay, this much money the corporation has been collected. And retained earning, this is inside earning. So if a company needs capital, this is the outside capital coming into company, but retained earning, it's $1 that the company earned himself after paying dividends. Whatever is left goes to retained earning, and this is inside earned capital by corporation himself, and that's 6.6 million. So total stockholders' equity is $63 million. There is no treasury stock, and the reason there is no treasury stock because here says 400,000 shares issued and outstanding. Since issued and outstanding are the same number, then automatically I know there is no treasury stock here. If it was a treasury stock here, then it would be a negative number, because treasury stock, it's a stock that the company buys back from market. Its own stock, the company buys back from market. And that will reduce the equity. Any question on this, please? Okay, so far so good. Let's keep going. See what else we have. Okay, treasury stock I already explained. It's shares of company's own stock that has been repurchased from the market, and the company puts the stock certificate in its safe box. That's it. When a company buys treasury stock, they need to record few things. Record the purchase, memorize in a memo somewhere how many they purchased, how many stock, at what date, at what price. They need to keep all those records properly. So here, when they buy treasury stock, so let's say they bought it for $25. So for 40,000 shares times 25, that's $1 million cash paid to buy the company's own stock back from market. So if that happens, now that treasury stock here shows 40,000 shares at the cost, and that's a negative impact to the equity. And here, just be careful when it says 400 shares are issued and 360 shares outstanding. Automatically here, by just looking at here, I know there is 40,000 shares in the treasury. So I don't need someone to babysit me and tell me how many shares are in the treasury, because here said 400 shares are issued, 360 outstanding. I know already my treasury is 40,000 shares. Okay, so be careful if you solve a problem or something and something like this is given to you. That means this is already your responsibility to understand that automatically. Okay. Any question on the treasury before we move on? Perfect. Let's keep going. Stock split and stock dividend. Stock split, it's a corporate action to increase the number of shares and reduce the par per share by stipulated ratio. So stock split happens a lot. Like, for example, let's see, 2-for-1. 2-for-1, that means for every one stock outstanding, all of a sudden they issue one more, so it will become 2-for-1 stock. That means if you had one share of stock today and tomorrow is 2 stock split, all of a sudden you will have 2 stock of the same company. So if you look at the recent things happened, let's say Amazon. So Amazon, if you look right now, it shows 107, and that was not it. That previously they issued stock split of 20-for-1. So this price was previously, let's say, $2,100, and now it's $110. Why? Because right at the moment that the stock split happens, the next second, instead of 2,100, the stock's price goes to $110. And if you had one share, now all of a sudden you have 20 shares. And why they do this? Because it's easier to, for me and you to invest in Amazon, because it's $107. Before it was $2,000, and it's a little bit harder to invest $2,000 in one share, but it's much easier for me to invest $300 and buy 3 shares. Okay. So if it's a stock split, you see the par value, let's say it's 1 for I don't know what the example is I have to read, but as you see, bottom line, the par value will change. Let's say before was $1 and there's, let's say 4-for-1 stock split, then the par value will be divided in 4 and becomes 25 cents. Here, $1 to 25 cents. Okay. And before that was 400 shares issued and outstanding. 400 shares all of a sudden becomes 4 times more. So 400 times 4 is 1,600,000 shares issued. So par value goes down and the number of shares issued goes up. The dollar amount is same. There is no change on the dollar amount here, but bottom line, the information will change. Stock dividend, it's a non-cash corporate activity to provide shareholders with additional shares in proportion to existing ownership, makes for more shares outstanding, but does not change total equity. Sometimes the companies, they don't have or they don't want to issue cash dividend, so they issue stock dividend, which is technically telling you that you will get free stock. So here says, let's say if a shareholder has 100 shares of a stock, will own 125 shares after a 25% stock dividend. 25% stock dividend, or essentially same as saying 5-for-4 stock. 5-for-4 stock is the same as stock dividend. So stock dividend and stock split is almost similar thing. So stock dividend, 25% stock dividend, that means you will have 25% more shares, or so-called, if you had 4 shares, let's say now you have 5 shares. And here is the important issue. It says, importantly, all shareholders would have 25% more shares, obviously. So the percentage of total outstanding stock owned by specific shareholder is not increased. Don't think, oh, now you are more shareholder. No, the percentage of ownership will stay same. So let's read this one. This is important. Although shareholders will perceive very little difference between a stock dividend and stock split, the accounting for stock dividend is unique. There is no journal entry for stock split anyway, so just so you know. But for stock dividend, you have to see. Stock dividend require journal entries. Stock dividends are recorded by moving amounts from retained earning to paid in capital. So we take when you pay stock dividend, so your retained earning goes down, same as cash dividend. When you declare cash dividend, your retained earning goes down. Stock dividend, same thing. The only difference is in the cash dividend, you have to pay cash, but if company doesn't want to pay cash because they want to buy equipment or whatever, so they issue stock dividend, and in that case, retained earning goes down no matter what, but they don't pay cash. They just issue stock. So that's the benefit of it. So the amount to move depends on the size of distribution. A small stock dividend, which generally we call it between 20 to 25 of existing shares outstanding, that's small stock dividend, is accounted for at market price of the date of declaration. So small stock dividend like 20 to 25, that is based on market price of the date of declaration. However, a large stock dividend, generally over 25%, is accounted for par value. So those are accounting issues that you might know in regards to small stock dividend or large stock dividend. To illustrate, assume that Children's Corporation had, let's say, 1 million shares of $1 par value stock outstanding. So 1 million shares outstanding, $1 par value. The market price is $20 on the date of stock dividend is declared. Okay, that's the market. Small stock dividend, assume Childers issues a 10% stock dividend. So that's a small stock dividend, right? Below 20-25%. So in that case, retained earning, yes, it goes down by $2 million, which is 10%. 10% of 100,000. Here is the calculation here. 10% of 1 million is 100,000, and 100,000 times $20 per market value at that moment, and that ends up to be $2 million. Okay, $2 million. Because the par value is just $1, obviously you cannot put more than $1 in the common stock. The remaining will be paid in capital in excess of par dash common stock. And you record the reduction of retained earning for $2 million. So the company is issuing stock, but is not receiving cash. It's reducing the retained earning. Okay. And the company is declaring stock dividend to not pay cash. They don't want to say cash credit. They want to say common stock credit. They want to give them credit, common stock to investors to keep them happy, but not give them money because they want to keep the money in the company to invest in new equipment or whatever it might be. But if you, let's say, assume this is a 40% stock dividend, so it's a large so-called stock dividend because it's more than 25%. So if it's a large stock dividend, then you issue that based on the par value, and that's it. So retained earnings will will be reduced only 400,000, and common stock will be increased by $400,000 based on par value. So 1 million shares times 40%, that will be 400,000 shares. 400,000 shares times $1 par value, and that will be the only dollar amount you will recognize. Here says it may seem odd that rules require different treatment for stock split, small stock dividend and large stock dividend. There are conceptual underpinning for these differences, but it is primarily related to bookkeeping. The total par value needs to correspond to the number of shares outstanding. Each transaction rearranges existing equity, but does not change the amount of total equity. So the total equity is not changing. The reason is, it's not showing here, but the total equity is not changing because retained earning goes down while common stock goes up, right? So if the retained earning is going down and common stock is going up, the total equity is still same. So here is a statements of stockholders' equity to look at. So here is the common stock $1 par value at the beginning of the year, let's say $20 million. And then they issued shares for cash. That's $3 million increase in common stock. Also, they issued stock dividend, small stock dividend. So that's $1,150,000 stock dividend. Common stock has been increased to, let's say, 24 million something. Paid in capital is, at the beginning was 25 million in this company, and they issued, because they issued stock here, you see $3 million, the extra cash collection goes in paid in capital in excess of par for 12 million. And stock dividend was issued for par in here, but anything above the mark, because they issued at the market value. For a small stock dividend, you go with the market value of the stock. So the additional dollar amount, instead of going to the common stock, because it's $1 par value, you cannot go more than that. So the additional goes in here as a form of paid in capital in excess of par. And then the retained earning at the beginning of the year was 11 million. Then they did a very good job in regards to net income. That's 4 million will increase the retained earning. They issued cash dividend of 1.5 million. So that will be deducted from retained earning. Retained earning goes down and cash will be paid. And then also they issued stock dividend, and that stock dividend will obviously reduce the retained earning, and that's the combination of these two numbers, 5,750,000. 5,750,000 for the stock dividend. Retained earning goes down. So retained earning at the end of the year is 7,750,000. Treasury stock, at the beginning, they had $5 million of treasury stock, and they purchased more treasury stock again. That's another $2 million negative impact. So total negative impact to the stockholders' equity is $7 million for the treasury stock. So at the end, the stockholders' equity at the beginning was 51 million. They issued some shares for cash. They bought $2 million of treasury stock. They increased the equity by 4 million because of net income. They decreased the equity because of cash dividend. And you see the stock dividend is not changing the equity. Why? Because in a stock dividend, the common stock goes up, retained earning goes down. It will not have any effect on the equity. That's why it's blank here. And the new equity is 66,500. Any question? Are we good? Okay, let's continue then. That's it.